right. Good morning. Welcome to the KNCCI Deloitte Financial Training. My name is Masharia Mogoye. We'll be the one probably taking you through the program today. So I think generally I'll be taking you through just general overview of what to expect today, and just yes, so we'll be having sorry, we've started a bit late. We were just waiting for people to join in as we go, but we'll start with some opening remarks from both KNCCI and Deloitte. Then we will have our first training session, which is on digital bookkeeping, and then have a question and answer. But even as we go, I think on your side, we all have question and answer sections that you can be able to ask questions as we continue with even as the training goes on. Then we'll have a small health break of 10 minutes, then start our second session on financial literacy and investment. Yes, it's financial literacy and investment, then also a question and answer, then just closing remarks. And that is the end of the program. So I think for us, is just to ask you to be engaged as much as you can, learn. If you have any questions, ask. If you'd like any clarification, please also do let us know. I'm sure the people presenting will be willing and happy to repeat if it's not clear. So for opening remarks, I'd like to welcome Mr. Keegan Kiplimo to give opening remarks on behalf of KNCCI.
Thank you, Masharia. Good morning, everyone. We are so sorry for starting a little bit later than we had expected. Thank you so much for making time. I know everyone has a lot of things in their diaries. We appreciate your time. Thank you, the Deloitte team, for making time to join us today and to carry on this training. Bookkeeping and financial literacy is very, very important for businesses. We hear from players in the financial services, and I'm sure as businesses you get to hear these more often than me when you go to financial institutions, and one of the biggest challenges they have with MSMEs is they don't have their books in order, they don't have audited financial statements, and essentially they just don't have records. And we know majority of MSMEs are still working with pencil and paper. In this day and age, bookkeeping can be done digitally, and we'll be hearing a lot about that and how that can be done effectively. So thank you so much. For those, I can see those of us who joined us in our previous series of trainings. Last time we had digital marketing for MSMEs. I can see some of you are here as well. Thank you so much. And we will continue this series of trainings. At the Chamber, we are committed to supporting MSMEs through capacity building in many aspects and in many ways. The Deloitte team will leave their contacts behind in case you want to reach out to them for further support of any nature. They will be happy to help. Thank you so much.
Thank you so much, Keegan. I think I'll now invite Mr. Peter to give opening remarks on behalf of you.
So good morning, everyone. Happy to be part of this conversation this morning. My name is Peter Mohoho, Senior Manager from Deloitte, and we are excited to partner with KNCCI and join this wonderful group of entrepreneurs in this very, very important session. So today, from a Deloitte perspective, is a very, very important day for us. Deloitte, we are a purpose-driven organization, and our purpose is to make an impact, and not only an impact, it is an impact that matters. And we understand the importance of the MSMEs in our economy. From statistics, I believe all of us we know and we understand the contribution that MSMEs are making in the economy. contributing or constituting around 98% of the businesses, and 30% of the jobs annually are coming from MSMEs and contributing around 3 to 4% of GDP, which is very, very important for our country. And the reason behind it, why even us as Deloitte, we really focus on this group, is because of that kind of contribution, which is very, very critical for the country. Based on that, we have been partnering with different institutions to make sure that we can have a wider reach to MSMEs, so that we can walk the journey and make sure that the critical part which you are playing in the industry is going to be felt and continue building our country. So we are excited to be here. As Keegan has indicated, bookkeeping is very, very important and critical for you to grow your business from where you are to the greater heights. And we are here, we are going to engage. We have a panel of specialists who will be discussing with you, and looking forward to an interactive session where we can exchange and share ideas. So thank you so much, and looking forward to engage. Thank you.
Right, thank you so much, Peter. So I think without further ado, we will begin with our session. Kindly, I encourage all of you, participate, ask questions. If you feel like you need clarification, kindly let us know on the chat. There's a question and answer also tab. You can just feel free to let us know. So I'd like to start by inviting our team from Deloitte Digital Bookkeeping to start us off with the training. Thank you so much.
Hello, can you all hear me?
Okay, so I think we can start for the essence of time, so that we make good use of our time. Once again, this is Peter. So I'll take you through in terms of what is the agenda, in terms of the digital bookkeeping, what we plan to cover today. Maybe we give just 1 minute so that the presentation can come up. In today's agenda, we are going to cover the following areas. Number one, we are going to give you an overview of our understanding of MSME challenges. There is an overview of bookkeeping and financial reporting. Why is it important for record keeping? MSME bookkeeping journey, bookkeeping background and history. We dive into the digitization, where are we today and where we need the world is moving. Things to consider when looking for the digital solution, expected digitization benefits, Q&A,
Yes,
and then we'll touch base in terms of the few areas relating to our service offerings. So without much ado, we go into the specific parts. The first part is understanding of MSME challenges. So from a Deloitte perspective, we have been focusing on MSMEs, as I've indicated, looking at the major contributions that MSMEs are making in the country. And this is through our unique Deloitte initiative called Deloitte Private, where we concentrate more on the family-owned businesses and private businesses, purely to make sure that we can make sure that we are focusing in giving new solutions that are fit for today and tomorrow. And through our engagement with the different MSMEs, we have come to understand there are some challenges which hinders the growth of family-owned businesses to the success, which in turn affect the business prospectivity and sustainability at large. So looking at it, we have classified this into two main categories. One is on the side of the process and the other side of the governance. So looking at it in terms of the processes, what are the key challenges that we find? We are looking at it from accounts and audit compliance. You realize that there's a lot that is required when it comes to the recording of your transactions. And some of these are already guided by the regulators. Right now in Kenya, we have what we call ISPAC. And this is where all the guidance are given in terms of how we record our transactions. And what it means is that if you don't comply with these reporting standards, you also compromise on the quality of the numbers and the reports that you're preparing and the financial records that you're preparing. So which means that you end up getting reports which can be what you call being disqualified, or if you look at it from even the financial institutions, you find those numbers are not going to be reliable, and you might get pushback from like the investors or even the financial institutions. The other one is lack of real-time financial reporting and insights, because you need to have a lot of information that is ready, such that whenever you're requested for some of the clarity, some of the data that can support a certain position, you will be in a position to provide the same. So if you don't have these proper procedures that are set, you find yourself that you're not going to be in a position to provide the real-time financial performance insights, which could be required. The other aspect is the aspect of operational excellence. And you find that due to the way MSMEs they operate, you find there's a duplication of efforts. There is so many systems you don't communicate to one another, and maybe you can coordinate based on the operation. You might find there's a system that is a standalone on this other side. Others, they don't have a system. And what this means is that it leads to inefficiencies and high cost of operations. And also, it becomes a challenge and overwhelming to the decision makers in terms of getting the strategic view of what needs to happen to the business, because we don't have information that is coming into a central space. The other aspect is what we call is enterprise risk management. And this is where you have weak risk mechanisms, including the aspect of cyber and enterprise resilience. So how ready are you in terms of understanding the risk that your business is carrying, and also how do you mitigate the same? So currently you find everybody is talking about going maybe to cloud, using some digital solutions. All of us, we are using in one way or the other, they're using some of the solutions which are available, but you still have that question, which risk am I carrying as a business? When you make that payment maybe through an online platform, what does it mean to your business? And what kind of risk and how do you mitigate the same? The other one is the leakages in the controls and mechanisms. You have seen MSMEs, you start up very well, you do a lot of effort, put a lot of resources, then within 1-2 years down the line, you find you're closing the shop. And you ask yourself why. Then you go and start checking, and you hear people start saying that maybe there was a fraudulent activities, I lost some of my inventory, maybe my accountant didn't do the right things. So those are some of the things that are coming in, that there are some weaknesses in the controls within your operations that would affect the way you run your business. The other aspect is tax and regulatory compliance. Every day you're waking up to hear that there are changes that are happening. Most recently is the aspect right now from Kenya Regulatory Authority. There's a whole aspect about conversations into compliance. There's an aspect of e-teams that is coming in. And you find if you're not compliant or you're doing things and what we call in a fishy way, such that you're hiding some of the transactions, this come and affect the way what is going to be the future impact if the revenue authority was to come and land on your table, and then you're not able to cater for the exposures which are going to be there. I think the other aspect which would come in is the aspect of non-compliance with the tax laws, which result to very punitive penalties and fines, which can be mitigated from the word go at the point when you're doing your operations, you are not under pressure, why not comply? So you find most of the MSMEs, you're not going through the right route, but people try to use shortcuts, especially when it comes to taxation. And unfortunately, as the business is growing, we are getting to a point where everything now is becoming digital. Everything is going to be very open. And therefore, these are some of the areas where you find if you don't comply, you are putting your business at a very high risk in future. The other critical thing is the aspect of governance, and we talked about future leaders and succession. And this is where you find most, especially the family-owned businesses, you have a very well-established businesses, but what is the succession? And that is why you find some of the good examples in the market where we have had very successful businesses, but maybe one of the first ones who was leading the business, maybe is the initial owner, maybe the father or the parents. If they are no longer there, you find that business cannot last for some time. And these are some of the conversations that we are picking when it comes to the aspect of the Deloitte project, where we can have this kind of conversation. Now, looking into that, and in the context of today's agenda, we'll be discussing about this aspect of the processes, especially on the side of the accounting, and what is it that is required for an SME to start preparing the journey so that you become successful today and also tomorrow. As we get into that, we just borrow one of the key aspects relating to one of the most successful investors in business, and this is Warren Buffett. He said, you have to understand accounting, and you have to understand nuances of accounting. It is the language of the business. And this is a very strong statement, looking at it and borrowing even from the example that we have just discussed, where we are talking about the aspect of the changes in the regulation in the market. When you listen to the nuances, like when someone says you're introducing something like e-tips, you as a business person, you as an entrepreneur, it needs to start thinking in your mind, what does it mean for your business? Because it means that if there is a change in the way the government and the revenue authorities are looking at some of the transactions, and you are not ready yourself to pick up and change, it means you will eventually erode the profit that you're going to get, especially when you start declaring some of the expenses. It's just an example, and there are so many areas within the business where you need to keep on understanding. Whenever you listen to the news, you go to the social media, you find there are some things which are being mentioned. How does that correlate to your business? And with that, we need now to go into the details. Allow me to invite my colleague, Jane, who is going to take us more in details in terms of the bookkeeping and overview of the bookkeeping as we progress with our session. Thank you. Jane, over to you.
Thank you, Peter. Good morning, everyone. I'll be introduced by Peter. My name is Jane Nevo, and I will take you through what bookkeeping is. We'll be going back to the basics on a high level, just to focus on what bookkeeping is. And hopefully at the end of this session, we'll all take out something that will have a lasting impact on our business. So when you look at bookkeeping, bookkeeping is a systematic recording of the financial transactions of a business, with the intention of generating reports that would be useful to the owners of the business. And the key purpose of the financial reports is to support stewardship of the financial resources of the business. So the recording of the financial transactions, which is bookkeeping, should ideally support the stewardship agenda. So the core of, or the main purpose as to why bookkeeping is done is to support stewardship agenda, and largely the stakeholders who usually hold the stewardship agenda would be the investors or the owners of the business. You have lenders would still be invested in that, and creditors, and even employees. There are various stakeholders who are usually very much invested in the and are interested in viewing the bookkeeping report. So financial reports, they help provide information to the users of the financial statements that would summarize what the economic resources of the entities are, in terms of what assets does the organization hold. Again, the bookkeeping reports should ideally indicate the liabilities or the claims against the entity, and they should also indicate the changes in the entity's economic resources and claims. So how does the movement in assets look like? And when you talk of assets, maybe we will be looking at things like cash, trade receivables, which would fall in the category of amounts that are due from the customers, and then the claims against the entity again would be the due from maybe lenders or even suppliers, and then what economic resources does the entity have. So whatever bookkeeping process is established, ideally the ultimate goal is to give the users of the information, or the people who hold the responsibility of stewardship of the economic resources of the entity, in this case the SME, the ability to have a better view of these particular aspects of the business, to enable them make informed management decisions that will take that business to the next level. Bookkeeping is a subset of accounting. There are various other aspects of accounting that we'll not focus on today. And then without bookkeeping, then given the summary that we've just outlined, then if an entity does not maintain books, then ideally maybe that entity would be equivalent to be operating in a dark, or it's a blind entity, because they are not aware of what they hold, what they are doing, what they owe other organizations, and even how they can potentially manage their financial resources. While maintaining the books of an organization, there are key aspects that should be considered. And as owners of an organization, or the stewards of the resources of the organization, it's good to be aware of those concepts or assumptions, so that even when you're reviewing the financial statements of the organization, then you have those concepts in mind. And as you review the financial statements, then you're able to query and ask the relevant questions, and also assess if those financial statements are representative of the current status of the organization, as at the point when those financial statements are being prepared. So one of the key concepts or assumption that should be taken should be considered when preparing the bookkeeping reports is that of a going concern. If it stands that an organization should be deemed to operate or to be a going concern or to be continuing in operation in the foreseeable future. So that organization should be deemed to have a future, such that in that case, then you're able to classify your assets into either current assets being assets that can be quickly converted into cash, and they can be used to support the short-term cash needs of the organization. And again, you're also able to classify your assets into long-term assets. And in the same case, again, liabilities, you're able to assess how quickly you're able to meet your liabilities and which ones you can delay a bit longer. So in that case, if you operate on a going concern basis, then at least helps the management make more informed investment decisions. Again, there is another concept called the accrual concept, where transactions should be recognized when they happen, in terms of income being recognized when it's earned and not when it's received. And expenses should be recognized when they are earned and not when they are paid. So again, that concept helps the business to have a better representation of their books of accounts from a bookkeeping perspective. And it gives a better picture or paints a better picture of where the organization is at. So bringing it home, if financial statements are presented and there is an event that happened maybe the previous week, it should be in the interest of the user of those financial statements, if they are aware of the event that happened, which should be the case for business users, then to find out if the bookkeeping system or process that they have established is helping paint a very good accrual or has established a very good accrual process, so that whatever income or expense or assets and liabilities are presented in the financial statements at any given point in time, paint the correct representation at that point. The other aspect that should be considered is the relevance of the information to the users of the financial statement. Relevant information is capable of making a difference in the decision made by the users of the financial statements, and the aspects that should be considered to assess whether information is relevant or not should be assessed either by nature or materiality. That whether when we withhold that information, will the disclosure or withholding that information influence the decision that will be made by the user of that financial statement or the bookkeeping reports? Then the bookkeeping reports that are generated by the users of the system or the process that's established by your organization should be structured in such a way that all the relevant information is captured and reflected there, so that the management then are able to make proper decisions. The other aspect is faithful representation. And to be faithful, the bookkeeping reports must be complete. They must be neutral, they should not be biased, and they should also be free from error. Having said that, what is the importance of record keeping? So we've talked about the ability of the bookkeeping reports to support the stewardship agenda of the investors. And in that, it helps them make informed decisions. It also helps them analyze the performance of the organization and track budgets. And budgeting largely then means that an organization usually plans the activities that they are to take to carry out during the year. It also helps the organization do proper stakeholder reporting, be it to investors, lenders, or to the tax authorities. It also helps in future planning, cash flow management of the organization. So coming closer home, so for instance, if an individual is running, say, a hardware business, maintaining proper records would ensure the hardware owner to know what is the stock value that they're holding at a certain point in time, which goods are fast moving, which goods have higher returns, which goods perhaps should they deregister or delist because maybe they're not giving a lot of returns to the organization, or where do they need to put more focus on in terms of compliance and such decisions. So there is no business that does not need proper bookkeeping, and a lot of emphasis should be laid on it as its backbone. It's a backbone of the business, even though it is deemed to be sometimes quite laborious. That's it from me. I hope you have all taken out something. It was short, but I hope all of you have at least taken out something that you're going to implement in your various organizations. So before I introduce the next speaker, we will focus on a quote from Peter Drucker, which states that whenever you see a successful business, someone once made a courageous decision. So I'll challenge all of us to revisit our bookkeeping basics and see if the reports that we get are reflective of what is expected and if they enable us to make informed decisions. And also at the same time make courageous decisions so that we can take the bookkeeping papers to the next level. Over to you, Ronald.
Thanks, Jane, and morning, everyone. So I'll be taking you through just the bookkeeping journey from an MSME perspective, looking a bit of just the history of bookkeeping up to where we are today. So looking at it from the bookkeeping journey, we have here a very, very simple and scalable approach in terms of how you can go about even in terms of your bookkeeping journey as an SME. And it's just a 5-step approach, starting with a business assessment. So very, very key, I think, as the previous speakers have spoken about, some key aspects that come off from a business assessment. One would be, of course, you'd want to check how your business is performing currently, and it would also help even in terms of forecasting the same for the future. Two could be, as a business, you're probably looking to scale up in the future. And scaling up, you might probably need funds from either, could be investors, could be banks, for example, to get funding from loans and all of that. And as we all know, a lot of these institutions do require financial records. So something to definitely think about as you're making a business assessment. And of course, in the current times that we are in, there are the regulatory requirements that are coming in, even in terms of, for example, now the KRA e-Teams that is the talk of the town. Yeah, so something very, very key to just think about those business assessments too, is to think about the approach. So as an SME, of course, one of the challenges that is there is that you might find that you don't, that in the particular business, perhaps the requisite knowledge might not be there. So you might think of, is it possible then, can I outsource that particular function? Or can I have it in-house? Of course, having it in-house, other decisions need to be made in terms of probably acquiring the knowledge, or if not, perhaps now hiring someone to help you with that. Then also in that, there's also the other aspects of which software or tools can you use. And very, very key is the accounting policies. It's key because there are two major schools of thought in terms of SME and bookkeeping. One is the cash-based accounting, the other is the accrual-based accounting. So an example would be cash-based is where you record your revenues and expenses as and when cash comes in. So take the example of a hardware business. So for the hardware owner, as he purchases the goods, he might procure the goods but only pay a week later. So in cash-based accounting, you'll only find the owner recording that expense as and when they pay to the supplier. But in the accrual-based accounting, they would actually say that they have an expense on their end as and when they actually procure those particular goods and services and the goods and they actually receive them. Very, very key, because what you find is for most SMEs, they do favor the cash-based accounting. But it's also important as you also do the business assessment. Where is the business going to? What you find is most of the corporations out there favor accrual-based accounting. So as a business, you need to look at it then from an investor perspective, from a lender perspective, from even a KRA perspective. KRA and the government at large currently is using the accrual-based concept. Of course, looking at the pros and cons, I think the easy one is cash-based accounting is easy, accrual-based accounting is hard. So they might so it needs to take very careful consideration from there. So number 3 is setting timelines when specific tasks will be due. An example would be, for example, cash. For example, you are recording cash transactions. Is this something where you will be doing perhaps a daily sort of reporting just to check where your cash position is? Is weekly more so what will cater to your business? Monthly, etc. Of course, it depends on the business that you're working with. In a lot of businesses, I'll give an example of a restaurant business. In a restaurant business, you would find that perhaps doing this on a daily basis, especially the cash, is very, very key because of the fast-moving nature of items and everything. So very, very key just to look at that so that you can also align how your reporting would be as an SME. Then number 4 is now going into the implementation of the same, where you need to start now recording and start tracking. So as you record, of course, you are trying to also just check the performance. You might have a budget in mind, and I'm sure other teams that will come later will speak into that. You might have other focus that you have in mind and all of that. So it's really now implementing recording and tracking. Then the last one is more so now trying to review how the current process is working. So it's always recommended in anything that one does to always review the current process, see how it's working, see if it's fit for the particular business that you have, see if it's fit for the business that you want for tomorrow, then improve the process accordingly. So very, very key just to look at that simple 5-step approach. And I'm sure for most of you, it's something that you can implement on your end. So moving on to it is just a brief background, just to demystify this bookkeeping journey. One, because it's that to understand, and also for just to understand for all businesses, bookkeeping is not something that started now or recently. This is something that started a long time ago. And looking at it, you'll find that some of the earliest records were even found in the times of the ancient Egyptians and in Mesopotamia. So if you look at probably the time at then, the culture was very different. People were living perhaps a very, very subsistent sort of life. But still, if back then they did feel that keeping records is very important, then what about today? In the current world that we are in, with even more and more challenges from regulations and all of that, it's perhaps very, very key. Going straight into it, how did it move? One of the key things is around the 10th, 15th century, around Europe. So just giving context of this, around Europe at the time, there's a lot of trade that was happening. And a lot of the business people in ancient Rome, in a place called Venice, they sought to try and make this process easier. So around this time is where you find the concept of double entry bookkeeping came around. So which was first described in a particular book Very, very difficult name. Very, very difficult name. But it's there called something Summa de Arithmetica. And pretty much it's one of the guiding principles that is almost one of the guiding principles that is actually used today. What that means pretty much is in an accounting concept, for every debit there's a credit. I'll give you an example. Let me go back to the hardware business that I was referring to. So in the instance where, for example, the hardware owner has procured goods, right? Has procured goods, and these particular goods, perhaps they'll use them as inventory to sell to someone else. So from an accounting side, this is an asset to them because they will sell it to someone else. So they would do a debit transaction for the same. But going now to the accrual concept of accounting, because as a hardware owner, the hardware owner has not paid the particular supply for the goods. So they will record a credit, and which is a sort of a credit, which is a liability to show that they actually do own that, they do owe the supplier because the supplier provided the goods to them. So that's just an example of the same. Flowing to it, another key thing that did happen from a history perspective is the Industrial Revolution. So around the 18th century, a lot of things did shift. Industries became quite large. And here is where you see, with the advent of corporations, you also see quite some need for businesses to have a good financial record for various purposes. As I alluded to, even for an SME perspective, looking at it in terms of the investors and lenders. Investors and lenders were looking at it to have financial records for a lot of institutions in order. And also with that, a lot of things did come around, even in terms of formality of the accounting profession, where you find a lot of the accounting bodies started to come up around this particular time. So very, very key. Industrial Revolution brought about so many things, besides, of course, the machinery and all, but also in terms of now the need and emphasis for bookkeeping. We thought it's just key to just mention the Enron scandal. So just a background is around 2001, there's a very large corporation in the USA, Enron, and they had a particular scandal. They had a scandal which really affected the company. The company, even looking at it today, the company is not there, but also brought a lot of regulations from an accounting perspective. It happened in the USA, but it's actually still felt here today. Some of the regulations which are being brought about by, for example, the Capital Markets Authority and all, can almost be tied to this particular scandal across the world. So it's very, very just key to look at, just to see that particular story, how it unfolded, how it affected the accounting firm at that particular time, how records were not kept, and all. And that's just coming in now to where we are today. From a current perspective, the accounting and largely bookkeeping profession, there are so many solutions. I think my colleague had mentioned this earlier on. There are a lot of solutions which are there in the market. So even as a business owner or as an SME, you might feel bombarded with all of that. So I think in this particular age, there's a lot of information, but perhaps what is not there is a lot of useful information for the relevant businesses. So looking at some of the tools which are coming up, generative AI, how will this affect the bookkeeping journey and all of that? Looking at it even in terms from a Kenyan concept, the way the revenue authority is looking at it from trying to incorporate and trying to view financial records for SMEs directly, for businesses directly, and how does that affect everything? So looking at it now from a digitization journey and where we are today, it's very clear. I think, as I just mentioned, there are so many solutions, there are so many solutions in this particular area, and even from an SME, then it can become quite difficult. Yeah. So from in terms of now the journey now for SMEs in Kenya, what is clear is for quite a large number is that digital records are not kept. Digital records are not kept. And one can put it that even from a Kenya perspective, the economy and the population at large is not yet so digitally inclined in a lot of things, leave alone bookkeeping. So perhaps what can be done then perhaps of that? Is it then knowledge in terms of, first of all, digital, then from there, moving on now to the key concepts now of as a business, how can I bring all the digital solutions to a business? Even in terms of now knowledge, time, and all of that. Looking at the solutions that are there, I think one you'd have to check what digital platforms, first of all, do you have? Do you have, for example, is it a laptop? Do you have a phone on? Do you have internet connectivity and all? And then looking at the solutions which are there. There are so many things which are there. One, for example, there's cloud-based and on-premise. So an example, a cloud-based solution is something where you can access it over the internet anywhere you are. So perhaps something to think about. But of course, cloud-based solutions currently in the market are they could be a bit expensive. So very, very key just for someone to look at that. On-premise, perhaps it is installed on your particular device that you do have. But then again, now the flexibility of moving for that might be a bit difficult. Integration, touching to the same point now that we were mentioning in terms of scalability. As you scale your business, in terms of the solution that you'd want to choose, can that solution integrate with what you want to do in the future? Integration in terms of even, I think we had the conversion with e-teams. Can it integrate with, for example, the other requirements that come in the market, for example, from the Revenue Authority or other authorities that may come up in the future? They are free and paid for solutions in the market, but with each solution, of course, there are pros and cons with it. So it's very, very key for someone just to look at it. And also looking at it, where is the future of bookkeeping? If you look at it and you read about it online, a lot of matters are being discussed about bookkeeping, how solutions can come into the market. Perhaps AI will come into the market and will make this bookkeeping journey very, very easy for everyone. At the moment, there are a lot of talks about that, but perhaps in the future, something of that sort will come. And then looking at it now, then for an SME, how to prepare for this? Of course, one is to just look at of course, just furthering the knowledge. Just furthering your knowledge, just to understand first the bookkeeping concept. How important is it for myself as an SME in my context? Will it help me to go where I need to go? Looking at it from a digitization journey, first, of course, would be to understand what is this digital? What does it mean in this particular day and age? In the day and age that we are in, the way everything is moving, digital and digital words are sort of quote unquote like the buzzwords in the time. But so it's very, very key to also look at from this digitization journey. Will it help me as a business to achieve what I want? Will it, also looking at it from the investors and all of the other requirements that come up, how will that evolve and how will that help as a business then to go through that journey? So as I leave you and invite my next colleague to just take us through, I just wanted to leave you with a quote from Aruna Bayana, which is, the biggest mistake a small business can make is to think like a small business. I think for all of us, even as anyone who does start a business, one is always looking at it in terms of where the business is today. I would like it to grow tomorrow. Okay, perhaps not. I would think that everyone on the call thinks about that, such that you're always looking at how can you scale your business to grow to where it needs to be. I think we all aspire to that. So it's very, very important, I think, for every one of us to just think about that as we listen to the talk and the session today. So over to you, Peter, the next session.
So thanks, Ronald. Picking up from what Ronald had just presented, we don't want to go back into that mistake where you are a small business and you're thinking that you're that small. The solution to bookkeeping is only digitalization. And all of us, we know where the world is heading. Everybody, including their own mother somewhere in the village, they're using digital solutions, including your phones. So even as a business, you need to go into that perspective. And for you to achieve the same, there is a specific journey that you need to follow, as Ronald has just presented. And there are some key factors that you need to consider, because as you have indicated, solutions are available. You are spoiled for choice, let us say, about the available solutions. And therefore, one of the key things that you need to consider is the aspect of cost. So many solutions are available, depending with the size of your business, your operations, there is a solution for you. However, you have to make sure that you consider whether there is any possible hidden cost and your business strategy in terms of the solution that you're looking into. So that again, you don't get into a solution that eventually, number one, does not meet your needs, and number two, maybe becomes extremely expensive, and then start eroding into your profits. Number two is the aspect of security. Everybody currently is scared about the information because we are holding very, very sensitive information in an environment which is not highly controlled by yourself. All of us, we understand, looking at it even from the digital solutions that we have on making payments, the information that you're holding for your organization, which is very close to your heart, and you don't want to disclose to anyone. What it means is that how do you make sure that the information is going to be secure? And some of these decisions definitely, for you to be able to make, you have to involve the relevant people, because they are key people who are specialists in the aspect of cyber security, the information when you take it into any system. So just engage so that you don't make assumptions in your decision, especially related to security. It is very, very important. The other critical thing is the user friendliness of the solution that you're going to take. Number one, does it meet your needs? And number two, how are you going to be supported? Is it easier for anyone in your organization to use, including yourself as an investor? Do you get any of the reports that you require? Do you complete your transactions with ease? We are heading to a point where you don't need to be wasting a lot of time doing what we call unnecessary things. You need to have a solution that is capable of making sure that you simplify the solutions that you have. I believe most of you have heard about the issue of cloud, and everybody talking about cloud. This is where we are heading. Most of the organizations are already here, and this is the future of the business. It is critical that as an investor, MSMEs, be close to this conversation, because that is where we are headed, and understand more in terms of what does it mean to your business and what do you require. Again, you might not be a subject matter expert in this space. Look for that particular person who can give you the details related to the cloud, so that by the time you're making a decision, you're making an informed decision based on your understanding of the cloud solutions that are there. Critical thing is what we started indicating, that SMEs could be having so many systems that don't communicate to one another. And therefore, you have to consider the aspect of integrations. Where possible in your operations, minimize as much as possible the aspect of human touch points. You can imagine right now the process that you go through to make a certain payment in your organization. How do you reduce on the individual touch points where possible areas of errors and manipulation and fraud can come in, so that again, you look at how and which are the integrations that you require. Again, this might be a heavy topic, and it depends with the conversation that you can get with the subject matter experts in this particular space. Scalability, I believe the aim of each and every investor is that your business can grow, and each and every day is growing to certain levels. So what it means is that based on the scalability, in a position to, so based on the capability to scale your business, also your solutions should be enabling you to scale up the business to where you want it to be. Financial reporting is also very, very important. And we are looking at it, how easily do you get information? And as my colleague had indicated, how best do you get information? Maybe 1 minute, we are having a technical issue. Just give us a minute. We resolve an issue we are having. Sorry about that. So I was talking about the issue of financial reporting. It is a requirement that as an investor, you require to get real-time information and information that at any given point can give you the true reflection of your business. And also when you're discussing to other investors, when you're talking to the lenders, when you're talking to the tax authority, you require that information that can be provided, which is accurate and real time. So it is important when you're looking for solutions. You don't go and have to do so much in customizing for you to get a report that you require. Maybe because you require a certain report to go, maybe for a very important business meeting, maybe you're meeting your lenders or you're meeting your investors, and then you end up wasting a lot of time getting your report as required. Now, based on that, what are the benefits of digitization? And based on this, we have to look at it in terms of the four main areas that you need to consider. Number one is the aspect of efficiency, because you want to digitize so that you become efficient in your operations. The other aspect that is very, very important is the aspect of errors and making sure that your records are error-free. How do you make sure that the information that you have is error-free? This is only by using solutions that you will have proper controls put in place. And that means you can have sleepless nights at any given point. There is the aspect of challenges also that you need to also put into consideration, the issue of connectivity, because also digital solutions means that you need to be connected, depending with where you're doing your business, how well are you getting your connectivity, so that you make a decision based on that kind of a challenge that could potentially affect in terms of you doing business because of connectivity. Then there is availability of the solutions. As you have said, there's a solution for each one of us in the business. So it depends with what we said, the business assessment, to know where you are, where you want to be. Now, what are the expected benefits that you anticipate through digitization? Number one is one critical thing is data access and reporting. So take an example. If you are a business person and you get a digital solution that gives you insights of how your business is performing at a particular time, that information, by the time it is landing maybe on your phone, it should be making a lot of sense to you. And when you talk about making sense to you, it means that if someone, maybe you're getting a report that you have made a sale of maybe 200,000, how does that now trickle down for you to understand the 200,000 that has been made today? What is the cost of sales and what is the profit that I'm getting to this? So that aspect is very, very important, and you can get from these digital solutions such that whenever you're in control of your business because you have data, and the data access and the reporting is critical. The other aspect is what you're talking about, accuracy. And as long as you put controls in your system that you're using, the accuracy of the information that is going to be there is going to be paramount, so that by the time you are getting those reports, you can sleep comfortably knowing that they are true reflection of your business. The other one is the aspect of speed. And we are talking about speed, especially also in the decision making, because as long as you have the information that is readily available, you don't have to wait for many hours or days before you analyze your performance, before you can get the information. It means that you can make critical decisions with high speed. Cost efficient, as we indicated from the beginning, you could be having so many processes that are duplicated. And if you digitize, you'll be in a position to identify where you need to bring the aspect of efficiency which comes back to the aspect of cost efficiency. The other thing is customization and scalability. We have indicated this and we have discussed a lot about this, where your vision is to continuously grow. If your vision is to continuously grow, these solutions are there and they can scale to the levels that you are getting. The other one is the aspect of security. As long as you have the digital solutions which you believe they are secure and your information is hosted in a secure environment, you'll be comfortable that that information is going to leak. And in case of any unforeseen circumstances, maybe like fire, you're not going to be worried that maybe my records are in somewhere in a file and my office may be accidentally got burnt out. So what does it mean? So that aspect of security is very, very important. Reliability is also based on the availability and how these solutions are available. And it means that reliability also gives you a cutting edge when it comes to the competitiveness, because you're going to become a reliable business. And I believe all of you have been affected maybe by one or two instances, maybe where maybe a mobile money maybe provider is down. And you find what it means in terms of your business, and that affects the reliability of the solution. And you can compare how often does that affect you vis-a-vis how often is the solution available to you. And that is a simple comparison that you need to consider and how it can help you when you're doing the business. So that's what we had relating to the digitization and the journey to digitization. At this particular point, we welcome quick questions and we will be answering the same so that we see how best we can respond to any of your queries. Thank you.
Right. Thank you so much. Do we have anyone? I think you can raise your hand. I think Caroline had raised her hand during as the meeting was going on. Caroline, do you have a question?
Yes.
Do we have any question? I think most businesses, as a small business owner, I think the main biggest challenge is when you sell something today and make 10,000, you think that your profit is 10,000, not considering that you probably had costs that you were had incurred before making that profit. So, Caroline Mongi, raise your hand up. Any question before we go on a short break? If there are no questions, I think I'll invite Peter to.
So thanks, and once again, we do appreciate the chance to have a conversation with you. Should you have any query that might come up, even after this meeting, we'll be giving you our contacts. Feel free to reach out to us. These are some of the areas that we support our clients on: financial accounting and operations. And you can see it's a variety of solutions that we provide. We also deal with the aspect of HR and payroll processing, outsourcing, and also support. And there is an aspect of business process technology that we can have a conversation around. We also cover all the industries and all the geographies within the region, and we can have a conversation around the same. So thank you so much, and looking forward to engage within the day. Thank you.
Thank you so much, Peter. So I think we'll take a small break and we'll be back at 10:40. Yeah, 10:40. All right. Hope you're back. We'll be going through our second session. Any time from now. Let me just give a few minutes. Yes. So I'd like to invite our next for our next session on financial literacy and investment decisions for SMEs, just taking us through to how to make better investment decisions. So again, feel free to ask questions, feel free to interact on the chat and the question and answer, and ask questions even as we go. They'll be answered either as we continue with the sessions. So let's welcome Mr. Abba to take over this next session.
So thanks, Masharia, and good morning to everyone. So that has been quite a good session in the morning about bookkeeping. Not so sure. In fact, the mood in the room is, should we start discussing about how Arsenal will win the trophy on this Saturday, or should we keep the conversation ongoing? Anyway, so my name is Laban Chege, and I'm joined by a team from the financial advisory team. On stage with me is Nora, Jolkas, and Ian. And we have our fantastic manager joining us online, Felicia Kirubu. We'll be taking you through financial literacy and investment decisions for SMEs. These are built up from what we have heard in the morning. So we're going to be speaking through quite a number of elements that at the end of the day will make us be better business managers, be able to make quite good decisions in regards to our businesses, and perhaps as well be able to essentially make the world a better place by the great empire that you're going to build from our businesses. So sorry. So how we're going to run through this? We're going to have it in 3 sections. So the first bit is we are going to walk through the elements of financial literacy, and thereafter we are going to link that to how we can evaluate investment opportunities that we're able to encounter in our day-to-day life. And then thereafter, we are going to handle it from a point of risk management and more specific to financial risks. So today, we are joined by an entrepreneur from Machakos. His name is Boniface. Through this case study, we would want to walk through an entrepreneur, and he's quite similar to the businesses that you're running. So ideally, we want to understand how he runs his business, and if at all he's able to anticipate the growth, and how he also plans to scale his business. So allow me to read through this. Then thereafter, we can be able to pick useful points that can be able to guide our conversation going forward. So as I mentioned, he's a mango farmer based in Machakos. He began his business, and he does have 2 full-time employees in his farm. The business is registered, and currently he's seeking funding so that he can be able to diversify into other marketable fruits. As you're going to see, that entails watermelons, etc. And of course, you also want to purchase 100-acre of a plot and expand operations beyond Narok. However, the key thing that we're able to see from Boniface is he hasn't been keeping up-to-date records about his business transactions, and therefore he can't really tell how he's going to how he doesn't have a good foundation in terms of how he's going to raise his money. And also he can't be able to tell how he has been accounting for the funds in his business. So this is quite a challenge that we see in most businesses that we run. or you're coming from a point of fine, maybe it's a sole proprietorship. You're thinking of registering the business to incorporate it. You're thinking of raising funds. You're thinking of expanding your operations. So many issues around our businesses. However, you've not taken the heed into the basics. And the basics comes into what you've had in the morning, bookkeeping, and that heads you to getting your financial statements in place. Also, that takes you to how you can be able to go around typical investment decisions that your business requires from a day to day. So these are the elements that you're going to walk through, and perhaps once you're able to do the 5 of them, we'll see if Boniface is in a good position to be able to scale, to be able to understand his business, and again to also scale it. So starting us off is the financial statements. In the morning, we went through the importance of record keeping. Ronald also took us through the 5 phases of how you need to go about it. But now the question is, what do they all lead to? They all lead to the financial statements. So when you think about the financial statements, hoping this is not very technical, there are 3 key statements that really speaks to a business. The first one is the statement of profit and loss. In other words, you can call it the income statement. We also have the statement of financial position and the cash flow statement. If I take, if I speak about the income statement, in a nutshell, this is a statement that helps us to know how you're going to transform your revenue into profit. So it walks us from revenue, you're able to track your revenue, you're able to track your expenses, and thereafter, you're able to see how that reflects into the profitability of the entity. So from the records that you're keeping on a daily basis, from the sales that you're making, be it on cash, be it on credit, that will feed into the revenue of the business. From the cost of getting maybe the materials that you're selling, that will lead to the cost of sales. This includes the direct cost that you're incurring to procure those goods from the vendors. Then thereafter, you do have some operating expenses. Think about it. The payroll, that's what you pay to your employees. Think about it, the rent that you pay for maybe for your offices or your operating base. That's what leads to operating expenses. Then after that, you're going to take into effect maybe the financial charges. Maybe you've taken a loan. Perhaps you're going to be paying an interest. You're going to be financing on a day-to-day, or you're going to be financing maybe on a monthly basis. That also leads to the income statement. And thereafter, you're able to tell the profitability or the loss position of your business. So an income statement is important in that it helps you to track all these items that you've spoken about. That's your revenue, your cost of sales, your operating expenses, and eventually you're able to tell about the financial performance of that business from a monthly or from a daily perspective, a monthly or a yearly perspective. The other one is the statement of a financial position. Just think about how are you financing your sales? I mean, you do have assets in your business. Why do you record them? You record them in the statement of financial position. So this is a statement that entails the record of your assets, your liabilities, and also how you are financing it, and that's through the shareholders, maybe equity. So it's important to maintain a balance sheet because you're able to evaluate so many things about your business, including the risk. You're also able maybe to take a decision about your capital structure. And if at all you're going to get maybe new financing, how does it alter your capital structure? Also helps you to assess your liquidity, the solvency, and the profitability of your business. It's an important statement because just think about it. We do have assets that you have in our businesses, but you're not able to tell, maybe if you don't maintain a good record of a fixed asset, you cannot even be able to substantiate what assets are helping you to generate your revenues. So it's important on a day-to-day basis as well to maintain this statement of financial position. And then finally, we do have the cash flow statements. Now, this one speaks more to the use, first, the source and the use of your funds. So it has three key sections. You have the cash flow from operating activities. These are the primary activities of your business. Think about it. If, for instance, you do
if for instance, if for instance we take Boniface. So Boniface is a farmer, and his primary activity is he does farm mangoes, which after all he sells locally to markets, maybe in Nairobi or wherever he does. But his primary activity is the mangoes. So the question is, what entails the cash flow from operating activities? Is that specific cash flows that are coming from the sale, from the farming itself and the sale of the mangoes. Then thereafter, you also have the cash flow from investing activities. And this refers to things of you're going to purchase more assets, maybe into the business. This is in terms of the capital expenditure. You're going to purchase your property, plant, and equipment just to help you keep regenerating the revenues in your business. So that's what falls in that. So on a year-to-year basis, we are going to see the change, and that is the money that was spent to acquire these PPE, or perhaps you may also decide maybe to sell some of those items. So you're also going to see the money that came in from the sale of the proceeds that came in from the sale of the PPE. And finally, you have the cash flow from the financing activities. So time to time, you're going to get new financing, be it in debt, be it in equity injection from your shareholders, or you're going to be servicing a certain facility from a bank. This is what lies in the cash flow from financing activities. What does that one communicate to you? You're able to track the source and the use of funds into your business. And so it's a very important statement, or rather financial statement to have for your business, in that it's able to communicate to you as the owner about what's contributing, or rather what's really leading to that reduction of the cash balance in your bank, or what's that adding into the cash balance in your bank. So you're able to tell it from that perspective. Now, there are key questions that you as an entrepreneur or a business owner, you can ask yourself. Maybe up to this point, you've not really incorporated the preparation of financial statements into your business. But again, there are questions that you probe yourself on a day-to-day basis that will help you understand the essence of these financial statements, and also be able to make decisions from the outcomes of these financial reports. I'll not go through all the questions, but rather I can just maybe go through 3 or 4. So from an income statement, perhaps you can ask yourself, was I able to increase my revenue? Was I able to increase my revenue? Again, that one is a question that you'll have to see maybe from the trend perspective. You're able to prepare financial statements from a year to year or from a month to month. You can be able to pick on the growth rates of your revenue, and that can speak through the health maybe of your sales. Another key question that you may want to ask yourself, maybe from a perspective of balance sheet, and more so from your trade receivables. The question is, are customers paying me before, maybe are customers paying me, or how long are they taking to pay me? Because sometimes the sales that you make may not all be in cash. Some can be in terms of credit. So that's a question that a balance sheet is going to be able to report to you. Of course, that's an interaction between a balance sheet and the income statement. Another question that you may need to ask yourself is, what strategic plans should I put in place to minimize the impact of unforeseen expenses? Now, that comes from a perspective of the budget and the actual performance that perhaps you have recorded. And that's an interaction as well from the income statements, marrying through the cash flow statement as well. So these are key questions. If you ask yourself a question as a business owner, that will help you know the importance of maybe having these 3 financial statements into your business. And finally, when you come to having spoken about the financial statements, and also having spoken about the trigger, the question that we need to really put ourselves to answer on a day-to-day basis, again, we think about what's the importance of the financial statements. And one is you're able to communicate to the stakeholders. I would want to imagine that most of our businesses are incorporated, and as well, we do have more than one shareholder. So on a yearly basis, maybe, or on a quarterly basis, you need to communicate about the performance of this business to the stakeholders. Question is, how are you going to communicate to them if at all you don't have a record that you can put into a financial that you have put for your business. So how are you going to speak to them? So you find it easy once you prepare these financial statements to be able to communicate to your stakeholders about the company's revenue, expenses, etc., and on an aggregate position, the performance of the entity. Again, you're able to make useful decisions. For instance, one is about the capital raising. If you look at your business, you're able maybe to tell the reason why you're not be able to expand into new territories is perhaps because you're limited in terms of financing. Maybe the reason why you are not able to satisfy the capacity of the market is because you don't have the to satisfy the demand in the market, is because you don't have the capacity maybe to do the value add of the mangoes for the case of Boniface. So ideally, you'd think of perhaps you need to set up you need to bring in new machinery into your business, and that can maybe lead to you need to perhaps get new financing. So it does help you to make key decisions about your business. Another one is about you're able to evaluate your performance, and that's about performance analysis. Then we also need to think about the business is growing. And so it means if the business is growing, you as a business owner, you need to be in a position to be able to do forecasting. You need to be in a position to be able to anticipate the changes that might happen. So you can only do that if you're able to connect the performance from a historical point of view, then to a forecast, or rather to a projected basis. So ideally, having the financial statements with you in your business is quite crucial for the health and for the growth of your entity. I would like to invite Nora to take us through budget and planning, and as well be able to build up about how we can be able to scale our business from a point of knowing, being critical or aware about expenses, and also anticipating those expenses and putting them into a budget such that you're not rushing to make what I can say unintended decisions in terms of maybe purchase of property, plant and equipment, or hiring new employees, or anything that you call it. So she's going to help us understand the importance of a budget and also how to do the actual planning.
Thanks, Laban. Good morning, everyone. I believe you're all in Kenya this morning, but good afternoon and good evening to the rest of you, wherever you are. So I'll be taking you through budgeting and planning, and I'm really hoping it will be as interactive as possible. Yeah, it will be as interactive as possible. So I'm curious, how many of you have budgets for your businesses? So maybe you can drop them in your chats and let's see, because it's a very practical thing that every business should have. As Masharia checks the comments, I believe most of you have either budgeted in terms of personal, but also I'm really hoping that most of your businesses are running on budgets. So what is budgeting? In basic terms, we'd say a budget is a plan that you write to decide how you spend your money, and it helps you align activities with the vision and goals of the businesses. So the most common myth of budgeting is that budgeting restricts. Even on a personal basis, if I was to do a poll right now, it's budgeting is a lot of work. Budgeting, I have to think. Budgeting, I have to, it restricts me. I have to every day figure out and put down every coin, and no one wants to be restricted. So as we start, I want you to put away that myth, that it's just a myth. What a budget does, it actually empowers you, because now it's not money that is telling you where it wants to go, but you're actually getting to see, this is the amount of money that my business has, and I, as the business owner, get to decide where does this money go. So, okay, class, we are together, right? Budgeting empowers us, not restricts us. So there are many types of budgets. It could be, there are more than 10 budgets out there, but there are 3 main budgets that every business should consider having. The first type of budget is the operational budget. So an operational budget, it's a detailed projection of what our company expects. So there are many types of operational budgets. There's the sales budget, there's the production budget, there's the direct materials budget. So Laban has just taken us through the different financial statements. And as you can see, the operational budget is mostly now the granular level. It's sales. So going back to Boniface and his business, it would look at what are his sales. He'll do a budget on how much mangoes is selling. Then it would have cost per mango. Then there would be now the revenue for each mango, because then you'll discover not every mango costs at the same selling price. There are some that have a higher price. Some have been bought from the market, others it's directly from his farm. So it helps you to get a granular, detailed sort of budget on the day-to-day operations. So an operational budget can be as frequent as possible. So it can be quarterly, it can be semi-annually, it can be annually, depending on the seasonality of your business. So what are some of the things that help you to actually come up with an operating budget? You can choose to focus on the trends in the industry, what's happening in the industry. There are so many publications that are publicized by different research institutes. You can check your previous data. How has my revenue been trending? Maybe depending on seasonality from January to let's say March, Q1 of the year. That's when I make most of the revenue. Then it also helps you to see where then you can focus mostly, and helps you to budget now for the seasons that there's no much sales that you're making. So you can also check what other competitors are doing in their reports. And also, if you have departments in your businesses, an operational budget is best done by different departments. By this, I mean, for example, Boniface, if he has a human resource department, then that department gets to do their own budgets. That way you're able now to track it deeper to what every department needs. The second type of budget is what we call the financial budget. So the financial budget is mostly used to check which financial resources does a business have and how can they allocate those resources. For example, in Boniface, maybe he sells the mangoes as a whole when they ripe. Maybe he also processes the skins of those mangoes that maybe some people come to consume in the farm. Maybe he dries the twigs after everything is sold and sells to other farmers who wish to use it as mulching for their farms. So it's not just one type of revenue that is coming in. So a financial budget helps to see every amount of money that is coming in and how best can they allocate it. So the financial budget goes in tandem with the financial forecasting. This is where now they come up with, in the next perhaps 2 years, 3 years, 5 years, how do I foresee the revenue coming in, and which are some of the other expenses that will be coming in. So mostly what is the key objectives of financial budget is the cash flows expected. Will there be any debts that are coming in? Will there be debt reduction? What will be the revenue that is expected to come? And then depending on once he analyzes the former financial budgets that he has done, he's able to see what is the actual versus projected business financial budgets. Now that's where we get analysis like, has the budget been hit previously, or have we been underperforming actually to the budget that the business is coming has been doing. So the other thing to remember is there's a quote by Barack Obama where he says, a budget is more than just a series of numbers in a page. It's an embodiment of your values. So as you budget, how you're able to actually track your expenses against what you have actually stipulated you're going to spend. So it's an embodiment of value. So even as you go back home today, perhaps you can ask yourself, how have I been tracking against the budgets that I've been making? And what does that exactly say to the values of my business? And lastly, it's the capital budget. So everyone has grand plans for their businesses. So for example, like if you do vision boards for your businesses every year, you want to expand, you want to buy that PPE, that equipment that you've always wanted for your business, you want to relocate to another setup. All those are actually expenses that are one-off, but they are quite bulky for the businesses. they require a lot of money when we use layman language. So you need a capital budget because you need to actually see how much does the business have currently. And this capital budget, do I have the cash? And should I use the cash that I have for the business, or should I source for financing from a bank? If I'm sourcing for a financing from a bank, depending on the revenue, how I'm getting it, let's say, because I'm going to pay that loan, let's say quarterly, will the amount of revenue that I'm going to get on a quarterly basis be able to cater for that amount of debt that I need to actually budget for these capex that I'm taking on board? So it helps to decide which businesses to pursue, which projects to pursue, because every idea is good for your business, but maybe you don't need to do it right now. And numbers don't lie. So you might think your business can afford that certain move, but if you actually do your capital budget, then you're able to foresee that perhaps me doing this major upgrade for my business is good. It will be good for my business, but I don't need to do it this year, or maybe I don't need to do it this quarter. But depending on how we are tracking, I can do it next year, or maybe I can take up another capital expenditure for now that my business can comfortably be able to accommodate. So those are the three main types of budgets. Moving on. Okay, so we actually have a poll. Do you have a budget? Masharia, how are we tracking? Yeah, 30 seconds. Do you have a budget? Yeah, so let's see. Oh, excellent. So 57% of you say they do have a budget. Then I think I should just close my books and go home because you're actually performing well. But for those 43%, I'll try and pitch to you. And hopefully by the end of this financial year, you'll have a budget for your business. So how does the budgeting process look like, so that 43% can see it's not as intense as you think? It's actually a pretty straightforward business. So first of all, you set out your objective. So that's what you are talking in the 3 steps. You've said, what exactly do you want? Do you want to see how your business is tracking? Do you want to have control for your business? Do you want to evaluate your performance? Are you planning to take a loan later in the year that now you actually need to track and see how much money you're making and what are your expenses, and will you be able to actually afford that loan? So you set out your objectives. Now, growing up, you always had those cases of businesses that started without objectives, and we all know what happens to them. So an objective is as good as your business. So the second step, once you have an objective, is develop the relevant strategy. So where do you want to be? Because this is your objectives, more or less, it's how you have a mission and vision for your business. So this is my objective, and this is the strategy for me to get to that objective. Once you have that, now you estimate the resources. Be as frank as possible. And as Masharia noted, one mistake businesses do is you imagine the revenue that you have made. If you sold 10,000, 10,000 is not your profit. 10,000, you need to deduct your expenses. You need to deduct so many things for you. You need to pay taxes. So after you've paid taxes, paid all your expenses, that's 10 shillings that you're remaining with. Now, those are your resources that now you're estimating. So be as frank as possible when you're estimating the resources. Then once you have all your resources estimated, I'm imagining maybe your business is a sole proprietor, but for any business to thrive, we try to earn as much as possible to advocate for a management sort of system, so that you have a third eye and other people who are looking to the business. Also, if you have management, it's good to bring them on board, because once management knows what the goals and objectives for the year, what are the targets, they're likely to be more motivated. So ensure you have management approval, that you're pitching to your management, to employees, this is our target. Because they're the people on the ground, they can give their comments on if they think it's feasible or not. Then after that, once it's approved and everyone in the C-suite in your company is aware of and has approved, then now you can decide to seek for funding with the budget if funding is necessary. So funding, the step number 5, it depends if your objective was actually to raise funding. If not, you skip to monitoring and control. So how often should you monitor and control? Again, quarterly, or it can be monthly. Just be as consistent as possible and keep on checking it as frequent as possible. Now, for a business to, every business should have a budget document, a documented budget process. This ensures that all these steps are clearly outlined. So for the 57% who have said they have budgets for their business, please, I hope you have a documented budget process, because even if you're not there, your employees can actually proceed with making a budget. So ensure that is documented clearly. Also, it makes the process faster and smoother. So lastly, in budgeting and planning, it's the importance of budgeting for the 43% again. So why do they need a budget? First of all, it's create plans. So remember, for you to make a budget, you need your objectives, you need your strategy. So it's a clear way of ensuring that your business has a plan. So Boniface can use this budget to help him implement strategies to meet his business goals. Cash flow management. It helps you to realize how much money actually do you have. So again, you might think 10,000 is your money, but when you do this budget, you realize how far you are from your goal and how much you have. So reviewing and evaluating the budget semi-annually or annually can help Boniface to plan better for his growth and profitability. That leads allocating your resources. How do you allocate? We say resources are minimal. So how do you allocate to them efficiently? How do you meet the objectives? How do you measure your performance? A budget is a perfect way of measuring performance, because you can see last year, this was my budget, but clearly I was 15% below budget, or maybe even 100% below budget. What am I doing wrong? Is it how I'm budgeting, or is it I didn't put in enough work to actually meet my budget? And lastly, it helps to identify and mitigate risk, because as you're budgeting, you can identify many problems maybe in your working capital, and as you identify those, it's helping you to actually be aware of how to mitigate this risk. As I conclude in budgeting, remember, once you're done with budgeting, there's only one rule: do not go over the budget and say, oh, maybe next year, maybe, but no, try as much as possible and stick to your budget. So after that, we'll move on to financing, if there are no questions. Okay, so business financing. Now, I believe for every business, this is quite a mix of any development. People have been finding most of the problems that we get from businesses is, how do I seek financing? I've tried so many things, but they're not working. So we'll go through business financing from a very high level point of view. So financing goes twofold: the financier and the one who is being financed. In this instance, most of us are here because we're in the second lot of people who want to be financed. So there are many sources of funds, like commercial loans, crowdfunding, there's family, friends, and business partners, there's incubators, there's chamas and credit unions, there's grants, and there's governmental initiatives. So we'll go through them in the next slide. Okay, so bank financing. Now, I'm sure most of the businesses here have actually applied for a loan in a bank, some successfully and some not successfully. So in many banks, we may be offered term loans, overdrafts, business credit cards. So what are some of the things you look at when you're considering taking a loan from the bank? First of all, it's interest rate. What's the cost of borrowing? So you have to figure out before you take this loan, so that you go back to your budget and see this cost of borrowing, am I able to afford it? Also remember, this, you will pay the principal, you'll pay the interest rate, but there are usually other expenses, the processing fees, there's the charge fees, all those are fees that later, if you're not careful, might be overwhelming to your business. So it's good to actually be clear. Do not take a loan in a hurry. Ensure you've met the relationship manager and you've actually gone through that contract that you're given, and ensure that you know what are the fees that I'll pay for the processing fees, the admin fees, what are the charge fees, which are other fees. In fact, you ask them, which are other fees that they actually anticipate that I will be tasked, that will be charged to me. So ensure you have maybe many of you don't know, but if you walk into a bank, you can actually choose to have a conversation with a relationship manager that is tailor-made to your businesses. So ensure you actually take them to study your contracts and ensure you always negotiate the terms of the agreement. In fact, our businesses actually negotiate their interest rates that the bank charges to them. So also consider your credit score. So whenever you're given loan, please pay back using the time agreed to, because this might impact your credit score. The second one would be digital lenders. So those ones would be, I don't want to mention them, but you know them, they are everywhere. And some you've seen them ranging from actually the ones that you can pay and take, and there are those, if you don't pay, they text everyone in your contact list. You know them, you've had stories. But if you choose to go the digital lending way, please ensure to actually check how valid they are. Have they been registered? What are their terms of loan? Which are the percentages they're asking you? How soon do they need it? You might take a loan and say it's okay, but apparently later they're telling you're supposed to pay this within 10 days. What will be the penalty if you do not pay? Some charge ridiculous amounts for penalties charged. So always do your due diligence. Businesses suffer because of not doing due diligence. Take your time, do your due diligence, and it will save you so much agony. So digital lenders is also a good way to raise money. The third one is credit unions and chamas. So we are all in circles. Some of the things you take into concern when you're taking a loan, a financing loan from circles is security, guarantors. Do you have guarantors? What again are their interest rates? Which other expenses are you expected to incur? What are your payment periods? Can you actually negotiate and tell them, no, I cannot pay this within 36, maybe we can do 72, etc. And actually, from a few experiences we've had with banks and all this, once you realize, because many things happen unexpectedly to any business, once you realize, based on how we are going, based on how the budget is tracking, we might not be able to pay this loan. Do not wait until the day that you're supposed to pay has lapsed and the bank is chasing after it to try and explain to them, this is what happened, I couldn't pay. It might be legit, but remember, this is a business like any other. Once you realize you might not be able to pay a certain amount of what is expected of you in a certain month or quarter, it's always best practice to go back to your relationship manager, let them know this and this is happening to my business, and then renegotiate for other financing methods. And maybe also they might consider pushing when you should have repaid your loan, or maybe they might tell you just pay the principal, the interest rate. Just go to your relationship manager and renegotiate the terms. Then there's crowdfunding. So we've seen GoFundMe and other crowdfunding methods where businesses actually pull cash from a number of individuals who might be interested in investing in your businesses. Next page, please. There are incubators. So the difference between crowdfunding is where now the crowd people get to fund your business. Well, a business incubator does not necessarily help you with cash. What they do is they will assist you by providing services. So for example, in many universities, they have science parks where they offer services such as management training, some even offer office space, networking. They will whenever they have fairs, they will invite you to actually market your properties, etc. So consider actually checking that. There is government initiatives. From time to time, government has had initiatives where they are encouraging and promoting SMEs. There is grants. This is money that is given to a business by a donor. Some you have to be repaid, and actually some do not need to be repaid. And lastly, it's family and friends. If you have a good pool of network, you can actually pitch your idea to them, and perhaps they might be willing to fund your business. Lastly, what are some of the key considerations that you might look at before seeking business financing? Assess your business needs. Again, we've all heard of stories, maybe back at home, or businesses that took loans without having a clear business need. And then maybe someone ended up buying clothes or having a good time with the loan. And then a few months later, someone's cows and their property being mixed away because they took a loan that actually they hadn't thought through the business need. You have to be clear. I'm taking this financing because of 1, 2, 3. And if possible, ensure that money goes straight to that to your business account or to the whatever financing need that you wanted, not to your account where maybe you had a few loans, etc., and you might forget to actually use it well. Understand your financial situation. Am I ready to take this loan? Yes, I might have a need, but based on my credit score, based on how the revenue has been performed, based on even the trends, maybe this business was making money previously, but because of so many circumstances that are coming in, macroeconomic, political, what's my financial situation of the business? That research different loan options, due diligence. Don't take loan in a hurry. Always do your due diligence. Which bank offers you better options? Which method is best for my business right now? So do your due diligence as much as you can. Then gather the required documentation. Do you have your audited financial statements? Do you have your business plan? Do you have your CR12 and other documentations that are needed? Ensure as much as possible. Do you have is your tax compliant in the last 12 months? All those required documentation, you need them. And for you to have those required documentation, you need to actually be in the proper records of businesses and of the government. So ensure you whatever needs to be renewed annually is renewed, NCS and everything. Always ensure you have the required documentation on a yearly basis and keep it close to you because you don't know when you need it. Lastly, seek professional advice. There are so many companies, there are so many individuals, even on a quick YouTube search, a quick Google search, you'll find individuals who will give you both virtual and some you will go to their offices and seek them, including us, Deloitte. We'll offer you professional advice, but ensure it's someone who is legit, it's someone who is verified, and it's someone who willingly wishes you well. So that's it for me, class. I hope I've impacted you. Thank you. I'll hand over to Laban to take us through investments.
Thanks, Nora. So I think that has been quite insightful. So at this point, I want to believe that now we have our financial statements in place. We've been able to, also we have our budget plan and you're quite clear about it. So that takes us to another key part of financial literacy. And on a day-to-day basis, you as the owner of the business, you're faced with typical issues that revolves around how you're going to invest in your business. And that's what we want to go through today. We want to just understand what are the criteria, what are the tools that you can use to assess investment opportunities, both from a quantitative and a qualitative approach. And also, what are the factors that you need to consider just before making that investment decision in your business? So I want to believe most of us have gone through, or rather have had this kind of phases in their business. Sometimes you think you want to expand, maybe beyond your operating zone, to another county, to another region, to another country. Also, maybe you want to invest in a new product line. Perhaps you found an opportunity to serve a different market, and you think you need to have another product. Sometimes you're also faced with capital expenditure decisions. Just like I was speaking, Boniface now want to seek new funding, perhaps to expand his operations. That will mean he also has to bring on board maybe new machinery into his entity. Sometimes you may think of trying to digitalize our business, and that's through adoption of technology. And the opposite of it is you may also decide, okay, so we know technology can as well take a few positions, and that means you may not have to keep having new additional employees. But maybe also sometimes you may think of, can I opt for having more manual processes, and that brings a question of having more employees, or even when you're expanding, you definitely need to bring on board new employees. That itself is an investment decision, because again, that will bring in an aspect of expenditure as well, and also investment in terms of training. Sometimes you're faced with a decision in terms of financing. So you'd want to either go the debt way, equity, hybrid. That's an aspect of, that's a key decision that you also need to make in your business. And I know most of the times you've had to make that decision. Sometimes you may want to diversify, and that calls for perhaps switching your, or rather realigning your portfolio, maybe to have new more products, or it may mean perhaps completely deviating from a certain business line to another. And that's all about trying to bring in value addition into a business. Sometimes you may think about restructuring. Some few things have not been working for you. And so these are the typical decisions that day-to-day entrepreneurs have to walk through. Just think of Boniface. Boniface was thinking of he need new financing. He's thinking of expanding. And I know with that one as well, there's going to be additional employees. Perhaps there's going to be more capital expenditure. And so these are decisions that you as a business owner needs to know they're going to arise in one way or another. And the question is, are you ready to do it, to make the right call for your business? So before we jump into how you need to evaluate the opportunities, we also need to think about what factors should you consider. And so some of them, we've listed them down. And one of them is your risk appetite. So often we talk about three types of people. There are those who are risk averse, there are those who are risk neutral, and there are those who are risk lovers. So you need to understand where you are. So some typical decisions will require you maybe to get into very risky operating zones, or maybe risky operating markets, or that product itself may not be well taken out in the industry. So perhaps you need to understand if there's a risk that you can be ready to invest in. Another key question that you need to ask yourself is about investment horizon. How far do you want to stay invested in this business? Is it 1 year? Is it, I can even start as far as, is it 6 months? Is it 1 year? Or is it 5 years? That need to be quite clear with you. For instance, if you think about some businesses, I think we have 4 clusters. There are those businesses that are quick. We call them in terms of cash flows. They are quite quick. Talk of a shop. A shop requires you to buy products and then you can sell to their consumers. That's quite fast. Think of a capital-intensive business. Think of Boniface, who's venturing into mango farming. He has to set up a mango farm. That requires capital to be deployed. He has to wait for the mangoes to mature. Not so sure how long a mango tree takes, but perhaps I would say 3 years maybe. And so that's quite a capital intensive project. So by the time you're getting cash flows from a mango farming, maybe it could be in your 4th year. By the time you turn into profit, that could be in maybe say 5 or 6 years. So that needs to be quite clear with you as an entrepreneur. Another key factor to consider is the return. What returns are you expecting from this business? Often we say, they are the risk, they are the return. Of course, that goes without saying. But now, you need to be clear. If, for instance, you're getting into the mango farming as Boniface, he needs to have known maybe historically how much returns do mango business generate. perhaps on a monthly basis, perhaps on a yearly basis. That needs to be quite clear. And even for you who is selling, maybe say, who is selling, who has a shop, what margins are able to make from a kg of sugar? That needs to be quite clear with you. So perhaps most of the times we are disappointed because we didn't do a good background to understand how we are getting invested, and also maybe to understand the return expectations coming from these that can be anticipated from your investments. The other one is the cost of investing. I mean, the initial capital outlay and also the successive capital that you need to keep injecting to your business. That needs to be quite clear. So think about Boniface again, who has a mango farming. He had an initial cash outlay that perhaps he put in his farm, which that maybe was in terms of, it took him up to the point of getting the seedlings, getting the weeding and etc., and getting the mangoes maybe to let's say 1 year into 3-year maturity. The key question is, once you have your mango, you need to take them to the market. So that will require you to procure logistical services. Another one is maybe you also need to do value add. That will maybe require you to do what? To invest in PPE. So you need to be quite clear about the financing that is needed into your business, and even at the different phases. Because most of the time that you are disappointed, you put all your money maybe into setting up the business, you forget a key important point of how you're going to finance your working capital, and also maybe other elements that requires you to put into perspective. Also, we also have to pay into perspective the transaction cost, which also sort of can gross up your cost of investing. Another key factor is your liquidity requirements. I think I mentioned a few elements of liquidity requirements. That is things that would require you perhaps to be able to raise, to be able to sort emerging needs that emanates maybe from working capital perspective, or that requires long-term investments. Think about selling a mango from a Boniface perspective. He needs to make a decision about, if he sells all the mangoes on credit, how is he going to finance his working capital? So that brings a question of, can you have a good balance between your cash and your credit sales? Because again, the concept of the business is you need to have shorter trade receivables days and longer credit days, right? So in a way that can keep your business well liquid, so that you're able maybe to even hit new opportunities that may arise in the course of your business. And now, finally, just think about your investment portfolio itself. Okay, so think about Boniface as well. He had mangoes. Now, what you want to do is you want to try other marketable fruits. His idea is of watermelons. He could go to lemons. He could go to anything else. The question is, when you diversify, you're able again as well to you're able again to control against the risk. You know, fluctuations may happen maybe from one product line. The other one can as well be able to balance off the risk that are rising from one line. So it's good to take into consideration that you need not put all your eggs into one basket, because again, sometimes when you think about the factors, be it internal or external, they may all asset classes, if I may say so, do not react or do not respond to emerging issues in the same way. So having a portfolio that's quite diversified helps you to be able to balance out your risk within your investment journey. Having said that, let's think about the tools that perhaps you can use to evaluate an opportunity. So do recall that we had quite a number of investment decisions that are likely to come up during your entrepreneurial journey. So the question is, how are you able to tell that this is the right opportunity to do what? To invest. I want to believe most of our businesses are set on the premise of we say government does offer services, but for a private sector or a business, I mean, you need to generate money. You know, you need to create income as much as you're offering the services. So ideally, you'd want to invest in a line that speaks to, you can get returns from it. So based on that, there are quite a number of tools. Not so sure what you use, but we're going to speak about 6 of them. And of course, also we're going to speak about one, which is qualitative in nature. So one of it is NPV. Thinking about NPV, it could be a very difficult term, but in a layman's way, just think about when you invest initially, today times 0, you're going to put in some money there, and that's the initial cash outlay. As you continue as well, you're going to be pumping money, perhaps in second month, that month, 1 year, 2 months, etc. So that's the investment one that you've put in. But again, this business is generating money this business is likely to generate cash flows during its life cycle. And so the cash flows now are going to be like the returns of your investments. So an NPV it's a criteria that sort of nets of the cost of investment from the cash flows that your investment has to be able to generate. So from a business perspective, we do say that you need to invest in a project that has a positive NPV. I mean, you need to invest in a business that definitely the expected cash flows are going to be by far higher than the cost of investment. So the question I would have is that how your business is responding to the investment that you have put in place? If at all you've been in 2 years in that business, can you be in a position to say, this is the money that I've put in the business, and these are the cash flows that I'll be able to generate from the business? If you look at the net effect, how does it look from your perspective? So based on that, you need to ask yourself, is it a worthy business to continue doing what? Get invested in? Now, for those who are yet to invest in maybe a new product line, this can be a criteria that you can try to deploy. But also you need to remember, for you to have maybe, let's say, a good idea about the cash flows that you expect your business to generate, you need to come up with those financial statements that we spoke about. Because financial statements, if you're able to generate the trends, you can be able to forecast. So the forecast, when you think about the forecast, that's what will be able to help you know what the cash flows do you expect, maybe N+1 years from now, N+2. So we need to think about, you need to see now the importance of a financial statement and how you can be able now to marry that, the forecast into being able to know if this is an investment that you can make. Another concept that is used is the internal rate of return. So well put is, this is the rate of return of your business. And the criteria is, you need to think about the cost of capital of your business. So the cost of capital is, you've taken a loan, what's the rate of, or rather, what's the interest rate? So maybe you've approached Bank X that's giving you a 12% interest rate. That's the cost of capital. But also think of a business that has deployed both equity and debt. So on that perspective, there's what also the shareholders expect from you. And so we also have the cost of equity. So put together, that gives you the weighted average cost of capital. So the criteria that you need to think about the internal rate of return, it should be that the criteria is, you need to invest in a business that has a higher IRR more than the cost of capital of your business. So IRR itself is a concept that sort of equates the cash flows from the business to the initial cost outlay or to the cost of investment. So in a nutshell, it sets the NPV to 0. So, but that's the key thing about IRR. Then the payback period. So payback period is as simple as that term is. The question is, how long are you going to take for your investment to earn your money back? Or rather, how long are you going to take for the investment that you've put in your business to turn into a profit? So again, this is sort of a complementary perspective from an NPV. So from an NPV, you're able to see from an NPV, you're able to see your cash flows into the future. As you keep netting off, the question is, are you going to get back your money, perhaps in the first year, second year, third year? So that's a key question. Again, remember you spoke about your investment horizon. So this is now a way to evaluate how long it takes for your business, the investment that you've put, to get back into your profit. So that's another crucial tool that you can employ. as a way to evaluate if that opportunity, if that decision that you want to make is viable. Another one is the accounting rate of return. Again, this one you're able to get it through dividing your annual profit and initial investments. Sort of common tools from what you've previously discussed, but now this is useful perhaps when you're thinking of multiple projects, and you are thinking of which sort of return does each project generate, and so you're able to pick that which has a higher rate of accounting of rate of return. Another one can be the PI, the profitability index. It's a measure of a project's whole investment attractiveness. Again, as a criteria, we are able to assess it. We are able to assess a good project that has a PI of greater than 1. Another concept that perhaps is quite common, and I know most of us think about, most of us actually speak about it, is the feasibility studies. I know before you set up that kiosk, before you set up that supermarket, before Boniface went to do the mango business, he had to think about the market. And most of the time, this is what we employ before we set up a shop. So this takes into consideration, how is that market served? How is the demand and how is the supply in that market? Another concept, another thing to think about from a feasibility study is how is the market regulated from that perspective? So for instance, if you're setting up a microfinance, there are going to be regulations. You're going to have to face up with the central bank and etc. So it also helps to understand the applicable regulations that are in place and how your business needs to be set up so that you're compliant. Again, it's able to help you understand about the operations. So think about, you need to know, yes, Boniface is planting mango, perhaps in Narok. Question is, how is he going to move the mangoes to a market in Thika? So that helps you to think about, you need to think about the infrastructure that's in place. Is it going to assist your business to be able to is it going to assist you to be in a position to be able to serve the market in Thika from your operating base? So that's a critical tool that you need to employ before you set up, maybe you decide to invest in that business. So just to now capital, none of these can actually, you can say that you can pin on to give you 100% success, not at all. You can use all these tools as complementary, and as well, you can even use other tools that perhaps are more closer to your business, and that will help you to have a better view of the business. Not saying that it's going to guarantee you 100% success, but it's important just before you decide to invest, just think about how you're evaluating that opportunity from a point of when are you likely to get back your money? Because again, like we said, these are businesses that are expected to earn you a profit as much as you are giving a service to the people. Once we share this deck with you, you're going to be able to walk through an example that you have of Boniface. So like we said, Boniface is planning to invest in a watermelon. He's trying to diversify from mango to watermelon. So definitely he has put in some money, and we've also set up an example where we have shown the kind of profits, or rather the cash flow that he expects from the 1 year to 5 years. And again, what that leads to. Now, looking at the point of the cash flows and the NP and the initial outlay, we come to a point of it's negative. So, I mean, the decision here is you should not invest in the business, because again, we said you need to invest in a business that has a positive NPV. So this is an example just to help you understand or help you walk through some of these tools that you can be able to employ just before you decide to invest in that business. So I hope, it's my hope that before we make the next investment decision, that is perhaps even happening at the moment as we are doing this presentation, that you're going to take into consideration the factors that you've spoken about. Think about, swim it through your financial statements, your budget, and as well now, think about how you're going to evaluate that opportunity, and is it going to be a value add to your business, or Are you going to be saying what we most of the time is saying in a layman way? Are you just going to be burning cash? Now, with that, I would like to invite Dorcas to take us through the final part of our discussion today, and that speaks to financial risk management, and then thereafter we can be able now to take your questions. Dorcas.
Yes, so good morning this afternoon. My name is Dorcas Wambua. I'll be taking you through financial risk management. This is the last bit. We are toward the end of the chain. So I'll make sure I'll be quick as possible. I know I'm standing between you and your lunch. Yeah, so we've learned a lot today. And financial risk management, it entails the identification, analysis, and response to risk factors that form part of the life of the business. So basically what I would like to say about this is we've invested, we've made the money, but we need to safeguard it so that we don't end up losing what we've worked hard, we've worked so hard to get to this point. So maybe I'll ask you a rhetorical question. What, if you think right now, what part of your business would you say exposes it to risk? Be it in operational, be it in the financial bits. Then as I'll give you 1, 2, 3 seconds to think about that. And then as we proceed through the presentation, you can get to gauge and see where the risk falls and how you can mitigate and understand the risk better. So we have various sources of financial risk. We have various sources of financial risk, and what we'll discuss today. Just a second. Okay. Yes, sorry about that. So what we'll discuss today are 3 bits of sources of financial risk. And the first one is market risk. So the market risk, these are we have interest rates. These are brought about fluctuations of interest rates. Then you have exchange rates. Exchange rates are brought about exchange rate fluctuations in the market, how the currencies are performing. And we've experienced this in the last 2-3 years globally, where the exchange rates have been fluctuating and affecting businesses. Then you also have the inflation risk, and this is brought about lessening of purchasing power. And inflation risk is also called a purchasing power risk. Then lastly, under market risk, we have commodity risks. So commodity risk is brought about fluctuation in prices of goods, e.g. raw materials. And then we also have related parties risk. So related party risk is brought about exposure you get when you interact with another party, for example, a bank, a customer, and all that. Then we have 2 types of risk here that are key. We have liquidity risk and credit risk. Liquidity risk is you as a business person not being able to meet your daily cash obligations, and when you're not able to convert your assets to cash. And I know this is usually a pain point for SMEs when you don't have money, your business, when you don't have a liquid position in your business, you feel like your business is not moving. Then we have credit risk, and this is a risk of not being able to pay a lender. This is brought about when maybe you engage a bank when you're getting a loan and something close to that. Then we also have other factors like fraud, erroneous reporting, poor governance, and cybersecurity. These are also other factors that expose you to risk. Cybersecurity is brought about digitization. As earlier our colleagues spoke about the importance of using digitization and embracing digital tools. Unfortunately, this comes with exposure to cybersecurity threats, and it's also prudent for someone to be aware of these risks and to mitigate against them. So once you've identified the types of risks, I hope you are also trying to, as you go along, to identify the type of risks that you have in your businesses. When you identify your type of risk, it's good also now to understand how you're going to manage this risk management. So you have 4 types of risk management processes. The first one is identify the risk, you quantify it, you strategize, and you monitor it.
So the first thing, we identify and name the risk and have a potential and identify the potential financial risk that comes about your business. If your business is probably exposed more to exchange rates, then you will first say like the main risk for you is exchange rate risk. If you deal a lot maybe with credit risk, you'll say with credit, you'll say the main type of risk you have is credit risk. Then the next thing you do is quantifying. So the quantifying in this stage, you analyze and quantify the severity of this risk. So there are various methods you can use. You have statistical methods, we have financial ratios, e.g., which is one of most of the common methods is debt to equity ratio. Then you also have data analysis analysis. Then the other thing is strategy, which is the third bit. Once you decide on a strategy, once you identify and quantify, now you need to strategize and say, this is how I'm going to mitigate the risk. Then you have various risk mitigation strategies that we're going to discuss in the next slide. And namely, on overview is risk avoidance, risk reduction, risk transfer, and risk retention. Lastly, monitoring. So once you've identified your risk, you've quantified it, and then you put a strategy in place, it's good to always monitor the risk and follow through often, so that you ensure that you are ensuring that the risk is mitigated, the risk is well, you have a structure such that the risk doesn't impact your business. So what you can say under this is the various monitoring types, various monitoring tools and types of methods you can use, and one of them is scenario analysis. I won't go into details about that, but I'd like to maybe go into details about the 4 risk management strategies. So we have risk avoidance, risk transference, risk reduction, and risk acceptance. And risk acceptance. So depending with the type of risk, it falls on the various 4 different categories. So risk avoidance is an approach that eliminates any exposure to risk that causes a potential loss. So basically what you do, you say, I will not engage with this kind of maybe business or this kind of transaction and avoid it at all costs. And this is usually very good if you see that the risk is very, can say it's material, it's big, and it will impact your business in a big way. Then the other thing is risk transference, and this is a risk management method that involves transferring your organization's risk to another party. And this includes things like insurance, getting insurance. So the insurance now gets to get the hit of the risk, and your business will not be impacted. You get contracts, you get joint ventures, and you get outsourcing. And outsourcing is one of what our colleagues spoke about in the morning, and those are one of the things that we do at Deloitte. And it's one of the things that we can help you with. Then we also have risk reduction. So risk reduction deals with the mitigation. This risk reduction deals with mitigating potential losses by reducing the likelihood and severity of a possible loss. So it requires more of a complex approach to investing, including full understanding of your liabilities. And risk reduction strategies include diversification and reduce investments. Lastly, this is risk acceptance. So you get to a point where you say, okay, this is my risk because this is the type of business I'm dealing with. I'll accept this risk and I'll move forward with my business, and I'll come up with these different types of monitoring and strategies to ensure that the risk does not impact my business. And what you can say about risk acceptance, it also depends with the person. If you feel like you as an entrepreneur, as an SME, your risk tolerance is at that point where you can tolerate this type of risk, where your business also can tolerate a certain type of risk and get a certain height of hit, then you say, I'll accept this risk and I'll move forward. And they also say the higher the risk, the higher the return. So also when you get to a point where you need to get to that, take a risk, don't feel like you can't do it, and don't feel like maybe discouraged and be shy of the risk, just take the risk and have a good strategy and have a good monetary plan and strategy. Yeah, so that's it on the risk mitigation. And I'll get it back to Laban in case you have any question. You can also put it on the chat. And thank you for your time. I hope you learned a lot today.
Thanks, Dorcas. I hope we have been insightful to you, and it's been a pleasure speaking to you. We hope you have a few questions for us, and as we wind it up, perhaps Mashari can be taking note of any questions that are coming through. So we have Felista online who is able to answer to our questions. Meanwhile, just to give you comfort about the people who will be speaking to you, we are what we do from a financial advisory perspective. We do valuation and modeling. We also do economic advisory. We also do corporate finance part of the advisory, and as well we are experts in mergers and acquisition and all transaction services. So we do hope that we can be able to work with you in your entrepreneurship journey. Just feel free to reach us through maybe the chambers, or we're also going to leave our contacts behind. Meanwhile, let's see if you have any questions coming through the participants. Okay. Yeah, we can share our slides. So we'll speak through sorry. Just a minute. Okay. So yeah, so I was saying that yes, we can be able to share the deck with you. We'll speak to the chambers, and I know you'll be able to access it from them. Sorry, there's a technical hitch, and we're fixing it here, but you can keep your questions coming.
on our side. But if we have anyone has a question, I think you can ask. Even if you have a comment, you can be able to raise your hand. I think I can be able to allow you to speak. So thank you, Shadrach. I can see you have a question, and the question is, what are the ways budget can be presented to a bank if you take a loan? What are the ways a budget can be presented to a bank if you take a loan?
Okay, thanks for that question, Shadrach. So when you're looking at applying for loans and the budgets that the banks request for, their requests are usually very specific. So you'll find that depending on the bank you're approaching, they'll ask you for budget versus actual performance, say, for the past 2 or 3 years and the current period. So the best way to always approach this is to have a bottom up or a top down approach in terms of your budget. And when we say this, we mean you need to understand how your budget builds up or stacks up against the operations you have as a business owner. So like now, for example, if say you are in the business of, I don't know, supplying stationery, for example, and you know, on average, you sell, I don't know, X number of carton of files or X number of carton of paper on a day-to-day basis, you can't then come and pick a figure for revenue out of nowhere and say, I'm forecasting my revenue sales this year will be, say, 10 million, but you know that you only have capacity of, say, purchasing and selling stationery worth 5 million Kenya shillings, for example. So when you're talking to a bank, because it's something they will always check, it's important to look at the reasonability of your budgets. And so this builds not just from a finance perspective, but from an operational perspective. What capacity do you have? How are you looking to grow that? What initiatives do you need to attain or achieve to be able to deliver on certain targets you're looking at? How much will this cost you? And then always compare it to how you are doing against that budget, i.e., if we are now in May 2024, so by the end of April 2024, by mid-May 2024, you need to be knowing, say my budget for the year was, say, I don't know, 10 million shillings. My budget to April was 4 million. What have I actually achieved based on that? And there's nothing wrong with reforecasting your numbers, i.e., looking at these are the decisions I thought I would make at the beginning of the year. This is how I thought my numbers would look at the beginning of the year. But given the economic times we're facing, or given, say, certain taxes or the depreciation of the local currency against dollars, against major currencies, for example, I don't foresee myself, say, being able to achieve this kind of margin, so I need to revise this down. So what is very important when you're doing a bank application is to understand, one, how your business operates through and through, what risks affect your business. Like when you're asked from a scenario perspective, what is the worst case or the best case scenario for your business, you're able to speak to that. Two, you need to understand their requirements as a bank. Some banks are more risk averse in comparison to others. So they'll ask for more detailed budget. They can ask you for more detailed forecasts or projections. So you need to think about how you want that business of yours to grow, so that when you're able to present those forecasted or budgeted numbers, they're speaking to that. And lastly, always be free to always think about sensitivity or scenario analysis for your budgets, i.e., tell yourself, best case, I think I can do 30. Worst case, I think I can do 5. Medium, I think I can do 10 or 15. And always look at your business from that perspective. Because if you only look at it from a one-sided perspective, what will happen is you'll end up being blindsided by certain events that could come up or happen. And what then that means is that you'll probably be always playing catch up, or you'll find yourself in excessive debt, or you'll find yourself with dead stock. So you always need to think about it from those perspectives. I hope that answers your question. I don't know if there are any other questions.
Sharika said thank you.
Okay.
Do you have any other questions before we close up? Even as we answer those questions, I want to launch a small poll. Just give us feedback that will help us in the next and upcoming trainings and programs that we have. So kindly just take a few minutes to answer the poll. Right. If there are no other questions, I'd like to invite Ms. Wangari Karanja to give us the closing remarks.
All right, thank you, Masharia. And just wanted to say thank you so much to everyone who's joined the virtual training today. I hope all of the information that has been shared by the Deloitte team has been helpful to you or will be helpful to you as you continue to run your businesses. Should you want to get in touch with the team, feel free to reach out to any of the team members at KNCCI, and they'll be happy to connect you to the Deloitte team. And to the team from Deloitte, thank you so much for just putting in all the work and effort to share your knowledge and to share your insights with the entrepreneurs present for the training today. And lastly, thank you for giving us the opportunity. KNCCI, we really appreciate it, and we look forward to more collaborations in the future. Thank you, and have a lovely afternoon, everyone. Back to you, Masharia.
Thank you so much, Wangari, and we look forward to having more trainings. So kindly let us know on what areas you'd like us to what training areas you'd love to be trained on, and we will see how we can be able to have those trainings in the future. Thank you so much, everyone, for attending, and have a lovely day.